Joining us right now on set is Barry Knapp. He's a managing partner and director of research at Ironsides Macroeconomics. And Barry, here we go. Markets are down yesterday, but barely. We are just below all-time highs. It seems like the move and the momentum is certainly up and to the right. What do you feel about things? How do you think? Are earnings enough to justify the places we're going? You think that continues?
They are for about half the market, right? So the tech sector is 30% of the S&P. Consumer discretionary, which is basically tech as well, is another 10, and communication services is 10. And if you look at S&P 500 earnings this quarter, they're on track to maybe get to 10% this year, but it's almost exclusively being driven by those three sectors. And it makes a lot of sense if you think about the whole dynamic last year. I was describing it as an unstable equilibrium where the household sector had termed out their debt, really wasn't at risk or particularly sensitive to the rate hikes. The same was true with the large non-financial corporate sector. But then you have this whole other dynamic, which is the banking system struggling with the deepest yield curve inversion since 1980. And that is, the banking system is the conduit to providing credit to small businesses, the real estate sector, and even the federal government. So in that environment, sure, being long tech works well. I think this is going to be a strong capital spending cycle, probably have above trend productivity growth through this business cycle. But then you have this whole sector that is struggling mightily with what I've been describing as nothing like 2008, because that's the lens everyone always looks at. NYCB has trouble and everyone says, well, is this systemic or are there credit problems through the system? The real comparison is 1980, when Volcker created this deep inversion of the yield curve that essentially started the chain of events that wiped out the thrift industry. Savings and loans, right? And they were 80% of mortgage credit at that time. So that deep yield curve inversion was an existential threat. They were being disintermediated by money market funds at the time. So even as the curve normalized, they couldn't raise money and earn their way out of all the losses they had on assets that they'd already purchased. And it's very similar to the regional bank situation now.
So you think the regional banks are in that much trouble that this is going to mean the end, essentially, of
for large parts of the market, they're going to need to consolidate or find another way to operate unless we get a real aggressive Fed rate cut cycle, right? And that sort of brings me to the big event of the week, which for me is not the monetary policy report to Congress. It's Friday's employment report, because there's just massive questions. It looked clearly like the demand for labor was weakening throughout the course of last year, and supply improved a lot in the first half of last year. Participation rates were up. When they did the annual population control a year ago, they found an extra million workers, mostly male immigrants, no surprise, right? This year, they said that the population fell by 625,000 workers. So if the supply of labor is dried up, even if demand's coming down, that's why we're stuck at a 3.7% unemployment rate and wage growth that actually has ticked back up in the last few months. I'm calling it my quadrilemma thesis, or 4 fours, is the idea that for the Fed to cut to 4%, the level that would disinvert the yield curve and take all the pressure off the banks, allow them to open the credit channel, lend to real estate, is going to take an unemployment rate above 4 and wage growth below 4. In which case the 10-year note yield can stay around 4 and not cause any further damage. But, so you're sort of stuck, and I'm saying, all right, well, I'm long tech, consumer discretionary, communication services, industrials, energy, materials, but anything remotely rate sensitive and the back end of the Treasury market, I want nothing to do with.
Do you think the Fed thinks the banking system is in as much trouble as you do?
I don't, but I would note that we had the Kansas City Fed president give his first speech as president of the Kansas City Fed after 6 months last week, and it was called Guideposts for a New Central Banker. And one of his guideposts was shrinking the Fed's footprint in the markets and trying to shorten the duration of their bond portfolio to try and allow, and he said there's all sorts of unintended consequences of this. It's the inversion of the yield curve that hurts the banking system. It's facilitating profligate government spending. So it was music to my ears, actually. And then Waller said something similar at the conference on Friday where he said he wants the Fed to shrink the duration of their portfolio as well. Basically let long-term treasuries run off and replace it with bills. That was the Fed's policy from 1951 through 2008. And they are influencing those long rates. And you may or not recall this. I certainly do. When the whole process started, you and I talked about this, and I was adamant that they should be more aggressive selling off longer-term securities and hike rates more slowly so they didn't cause this curve inversion. So I think they're still looking at this from a 2008 lens, and they're looking, like I heard Mary Daly talking about it the other day. She says, well, we're looking for office real estate problems. That's not the issue. The issue is that you own assets that may perform.
The issue is the lenders themselves.
Well, think about New York Community Bank. They have a whole portfolio of rent-controlled apartments.
They can't rate.
That might have been great when the interest rates were 0, but not when the policy rate is 5.5%. Your rents are never going to keep up, and the asset value is just going to go down and down. So you can extend and pretend that, okay, these assets are fine, but it's like the treasuries they own at 1% and the mortgages that they issued at 3.25%. Those assets, if you had to sell them, are trading at 80 cents on the dollar. And so that just creates, if nothing else, a big bunch of ballast on their balance sheet that prevents them from lending.
And getting back to a
and by the way, lending to the federal government as well, because the banking system is crucial for all that treasuries they're issuing 2 years, 3 years, 5 years, 7 years. So that problem needs to work its way out.